What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about opportunity zones. Now, opportunity zones were created with the passage of the Tax Cuts and Jobs Act in 2017. What this did was it allowed the governor of each state to choose certain low-income areas in their state based on census tracts that would qualify as opportunity zones. So opportunity zones have special tax incentives to help stimulate investment in those areas. Generally, you're going to invest in an opportunity zone through a qualified opportunity fund. So think similar to a syndication where there's a fund put together, you're going to invest in the fund, you receive a K-1. Now, there are ways to start your own investment and qualify for the opportunity zone treatment. That's beyond the scope of what we're going to talk about today and not quite as common. Most common ways to invest through a qualified opportunity fund. Now, to date, there's been over $2 billion invested in opportunity zones, so it's a pretty popular program. It's one area that actually has bipartisan support. There's been talks of extending the opportunity zone investment dates. Nothing's happened yet, but there were talks about extending it, and it does have bipartisan support. So the tax incentives that are provided by opportunity zones allow you to defer capital gains from the sale of any capital asset. So that could be real estate, stocks, bonds, cryptocurrency. As long as it's a capital gain, and it could be short-term or long-term, then you can defer tax by investing in the opportunity zone. Now, the opportunity zone does not eliminate depreciation recapture as tax as ordinary income. It's only going to apply to capital gains or Section 1231 gains, which are similar to capital gains that result from the sale of business assets. Now, that deferred gain, when you sell, you have a capital gain, you invest in an opportunity zone, that gain is deferred and it will not be taxed until you file your 2026 return. So by April of 2027. Now, if you would sell your opportunity zone investment prior to that date, it could be taxed earlier, but generally it's going to be deferred until then. So it's not a tax elimination strategy on that capital gain. And the difference between an opportunity zone, unlike a 1031 exchange, you don't have to invest all your proceeds. You're only investing the gain if you'd like. So you get to defer the gain until you file your 2026 taxes. So the tax will be due April 2027. Now, if you've already invested and you've held the investment for some time, there is a potential way to eliminate some of the tax. So if you held the investment for 5 years by the end of 2026, your basis is increased by 10% of that deferred gain. So if you had a $10,000 gain invested in an opportunity zone and you held it for 5 years, which means you were invested by the end of 2021, then you would only pay tax on $9,000 of that gain. If you held it for 7 years by the end of 2026, so you invested by the end of 2019, your basis would be increased by another 5% for a total step up of 15%. So you'd be taxed on $8,500 of that $10,000 gain that was invested in the opportunity zone. So here we are, summer 2024 or fall almost 2024, and the investment period, you're not going to be able to hold it for 5 or 7 years by the end of 2026. So this would only apply if you've already invested. Now, what does still apply to anyone that invests in an opportunity zone, even now, if you hold the investment, that qualified opportunity zone investment, for at least 10 years, you get a permanent step up in basis and pay no tax on that opportunity zone appreciation. So you defer your gain and invest in an opportunity zone. You're going to pay tax on that in 2027. But the opportunity zone investment itself, if you own that for at least 10 years, you will not pay tax on any of that appreciation. There's also no depreciation recapture from that opportunity zone investment. So the ability to invest in opportunity zones is set to expire at the end of 2026, December 31st. So that would be no new investments after that time. So existing investments are still fine. The program runs through 2047 when it's expected to fully sunset. Now, that was this expiration date of December 31st, 2026, that there was discussions of bumping that out 2 years. I wouldn't be surprised if they end up extending it somewhat. Nothing's happened to date, so just for now, no new investments after December 31, 2026. But again, it's a popular program. Hopefully we'll see an extension there. Now, obviously, with anything with the IRS, there are certain rules you have to follow. Generally, you have to invest your funds, the eligible gains, within 180 days. Now, special rules apply to gains reported to you on a K1, so think from a syndication. There, you have 3 options. 1, 180 days from the transaction date, which is the general rule for everyone else. Or if you sell a stock or real estate you own personally, it's going to be 180 days from that transaction date. But with the K1, because often when you receive a K1, you might not have enough information about the gains until you actually receive your K1. So the other 2 options give you 180 days from the end of the partnership tax year. So generally it's December 31st for calendar year partnerships. So that would put you out until almost the end of June the following year. Or 180 days from the due date of the partnership tax return, which is generally March 15th for a calendar year partnership. So 180 days from that's going to put you out to September. And again, that's likely because you're probably not going to have enough information until you receive your K1, unless you're involved in partnership management. Now, the election to defer the gain recognition is made on your personal tax return on Form 8949. There's a code Z that tells the IRS, hey, here's this capital gain. However, I'm not paying tax on it now because I invested the funds into an opportunity zone. And you also have to report certain information about the opportunity zone investment every year on Form 8997. So each year through your tax return, you're going to file this Form 8997. And that gives the IRS information about that opportunity zone investment you made. Now, you sell, let's go through a quick example. Let's say you sell a property on July 1st, 2024. And you have a capital gain of $100,000. Now you invest that $100,000 gain in a qualified opportunity fund in, let's say, October of 2024 and defer the capital gains. You're within the 180-day period. You can defer the capital gains. You're not going to pay tax on this gain until sometime in early 2027 when you file your 26th tax return. Due date being obviously April 15th of 2027 to file your 2026 or pay your 2026 tax liability. Now let's say you hold the investment until sometime in 2035. And at that time, you sell it for $250,000. So you invested $100,000, paid your tax in 2027, but that qualified opportunity zone investment has appreciated $250,000 by 2035 when you sell it. Also, during the holding period, you receive $60,000 of depreciation deductions. When you sell in 2035, because you held the investment, qualified opportunity zone investment, for over 10 years, there's no tax due on that $150,000 appreciation. And there's no depreciation recapture on the $60,000 of depreciation deductions passed through to you. That's because you held it for 10 years. So really nice tax incentive there if you can park the money in an opportunity zone and hold it for at least 10 years. So to summarize, opportunity zones started with the Tax Cuts and Jobs Act that was passed back in 2017. It allows you to defer capital gains if they're invested in an opportunity zone within the 180-day period. The tax on the deferred gains will be due in April 2027 with your 2026 tax return. And if the opportunity zone investment is held for 10 years or more, there's no tax due on the appreciation and no depreciation recapture to deal with. That about does it today in our talk on opportunity zones. Hopefully you found value in this episode. If so, please leave us a 5-star review or hit that like and subscribe button. And until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.